Hey everybody, Dave here, Hidden Freedom. Welcome back to another video. In this video, I want to go over about 3 different ways that you could fire and withdraw off your portfolio and live. I'm going to talk about a traditional way. I'm going to talk about another popular way. And I'm going to talk about the way I'm going to do it. And then, obviously beyond that, there's a bunch of other ways you could do this as well. So there is a bunch of different ways that you could skin this cat. So, let's go ahead and get started. So I'm not talking about lean fire, I'm not talking about fat fire, I'm not talking about coast fire, any of that stuff at all. So don't get those confused, because those are different things in general. Those are for people chasing fire. And this doesn't necessarily have to be for fire people. This could be just for general people that aren't chasing fire. They reach 55 years old, they reach 60, 65 years old, and they can do one of these methods here. So the very first option I want to talk about is probably the most common. I'd say it's the most common, at least in the fire community. It's probably the most common way. And what we're talking about is investing in like VT Sax, VU, or VTI are probably the most common. We're going to use $1 million portfolio as an example for all 3 options here as well. So what the premise is, you invest $1 million in VT Sax, VU, or VTI, and then you withdraw 4% a year, which is $40,000, and then you live off of that. And then the next year you can adjust for inflation, and that should, every year after that you should adjust for inflation, and then it should last 30 plus years. And that is the most common. It's the most talked about, I'd say, probably in the fire community. And it's talked about, I think, believe it or not, I think Irish Journey was doing that, Root of Good was doing that, J.L. Collins talks about it, Go Curry Cracker talks about it, Go With Less talks about it. So all those people were talking about this particular method, which they all had probably more than $1 million. And so obviously they adjusted it, their 4% withdrawal rate, I think, is what they talked about. But most of those people, actually all of them, either some have their YouTube channel or they have a blog, and all of them, but maybe Go With Less, can support their living, whatever they need to live on annually with either a YouTube channel or a blog. So it's really not a good use case. They might have started out doing a 4% withdrawal rate, and then they started making more money on the blog, and then that just took over, and they're probably not even touching their portfolio at this point. So in general, the overall market should go up 8% a year on average. So that 4% withdrawal rate should technically never run out of money, at least for 30 years. It's been tested. The Trinity study has been tested. And we're going to look at a example here as something you could test it, your own options as well. So what we're looking at here is we're just looking at C-Fire Sim. If you wanted to throw $1 million in here, $40,000 spending, and we're adjusting for inflation. I put it as equities 95%, bonds is 5%. You really, if you can stomach it, intestinal fortitude it, I would say try to keep those equities up to 100%, 95 to 100%, 100% ideally. You're gonna have a lot larger U-Haul fall in your hearse at the end of your life than if you had a larger bond holding there. And that is the key, right? If you wanna be the George Costanzas, or the Costanzas, I should say, and die with 0, then maybe you won't have a bond position there. But right now, bonds don't pay hardly anything, if not really nothing at all. Equities, a larger position in equities, you're going to have a big old U-Haul by the time you die. So ideally, keep those bonds down as low as you possibly can stomach. It might smooth out some of the bumpy rides, some of those bumpy years there. But, once your portfolio gets too big to fail anyway, what's the big deal about having some bonds, right? Maybe have 1 or 2 years living expenses in there, and then that's it. All right, now that's just my recommendation. That's what, really, I'm probably not gonna have any bonds at all. But I might have a little bit of cash hanging around, I don't know. So you can throw in this simulator, you can throw Social Security in there, you can throw pension in there, you can throw any other income in there as you want as well. So if we run the simulation at these particular numbers, we get a 95.87% success rate there. and that's through 121 total cycles there. So that's a pretty good success rate. You can play with those numbers. You can do like $36,000 withdrawal rate if you want to do that, which is a 3.5% withdrawal rate, somewhere around there. And you can throw Social Security in there and all that. But look at this here, you know, medium ending portfolio, $2.2 million. Okay, so you're starting out with $1 million. Guess what? There you go. By the time you die, what I'm talking about, a larger U-Haul, right? $2.2 million when you die. You're not a George Costanza, all right, because you're going to end up dying some money there. So you can play with this sim. This is a very well known simulation. There's other ones out there as well, but this one's open source or open free community, whatever you want to call it. So what's the second method? The second method is probably another real popular one, not necessarily for FIRE people, although some FIRE people do this method, and that is dividend investing, individual stock dividend investing. So what we're talking about here, we're gonna just look at my portfolio because I do have individual stocks, dividend stocks. So here is my dividend portfolio amongst, I do have ETFs in here, so we're not gonna talk about those, but all my individual positions in here, I have 21 individual positions. Now, when I started this portfolio, I had over 30, 35 positions in there. You can invest $1 million in a dividend portfolio. In all those individual stocks, you know, try to go with aristocrats, try to go with kings mostly. You can throw a couple of, you know, Hail Marys in there if you want as well. But in general, all these stocks in here are going to hold up very well to a lot of market fluctuations and declines because they're the most well-known, talked about companies that people invest in. They have dividend track record, raising dividends every year. In general, they all have pretty good dividend CAGR as well. My 35 stocks, I had roughly about a 3.5% dividend across all of those stocks. And then I had about a CAGR of about 8%. So that means that in general, all my dividend income should go up by 8% every year, which should outpace inflation, right? So obviously this method is going to take a little bit more, I'd say, capital if you want to live off dividends. So, you know, if you have $1 million portfolio with a 3.5% dividend rate, that's $35,000 you can live on every single year, and then it'll go up by 8% a year. So technically it should outpace inflation, and eventually the dividend portfolio should grow as well, especially if you're reinvesting those dividends. So that is another method that you go. A lot of people, traditional investors, go this route, not necessarily people on FIRE. I'm not saying this couldn't work for FIRE either. This could work for FIRE as well. And so $1 million there, $35,000, obviously you get it increased every single year. And this is going to hold up well during a market decline as well. Now, the overall market, the VT-SAX, the VU or the VTI, that's the overall market, right? That could fluctuate more than this because these are going to be a little bit more stable. They're going to have a lower beta probably than the overall market as well. So, you know, this is another way you could go. If you have a little bit more capital, I'd say, because the $1 million, the $35,000 is not a lot to live on unless you have a paid off house or something like that. So this way usually is for the 55, 60, 65-year-olds, which, you know, they have a little bit less time on their, you know, life to live, and they probably have a lot more that they could throw into it as well. But in general, you know, either one would probably work. You know, like, it's debatable which one would be better in the end. You know, it's very tough to make that argument that SPY, investing in VTI, VT-SAX, VT or VU is better than a dividend portfolio. In general, I'd say the SPY, or, you know, just an overall market SPY, VT-SAX, VU, and VTI, VU, which all have lower expense ratios than SPY, those probably are going to do better than a dividend portfolio in the end. But come on, I mean, it's, you know, the people that say, oh, this is going to kill us, you know, it's like, you know, it's just one size up U-Haul. You know, you're still going to have a large U-Haul either way, but it might just be a little bit bigger U-Haul, investing in an overall market. So, but, you know, in general, I'd say investing in dividend stocks, you might sleep better at night having that income come in and not have to touch your principal, right? Because in a down market, invest in an overall market, like I talked about in the very first option, you're gonna have to pull out of those, you have to pull off your portfolio, right? You're pulling out 4% a year, whether the market's up or down. And that could draw on you mentally. So those two options are pretty darn solid. That brings us here to the third option. And this is kind of the option I'm going with, at least to start out. And what I'm doing is I'm using a hybrid portfolio, okay? And that means I'm investing in income ETFs. Not to mention I do have real estate notes there that provide 6.7, almost 6.7% across those notes. And then I have some, QQQ over here, I have a SPY over here, and IW over here, which is the overall market in general, right? So I have a hybrid portfolio there. Now with $1 million portfolio, and I'm using basically $2 million portfolio for my example, but $1 million portfolio there, you're gonna have roughly, it's roughly about 6% or something like that. Maybe a little bit less than that. It depends on how you mix all of those income ETFs, right? NUSI is 7.5, QLD is 11.7. You got XYLD there, 9.5. You got Devo, which is a very solid play, is a 4.88%. You got SCHD there is 2.9%, right? So in general, let's just say you're at 5%. So you'd have $50,000 that you can withdraw, right? And then, obviously that takes care of your living expenses there on the taxable side. And then this other side over here, you have growth there, right? You have growth still. And then by the time you can, withdraw from your tax deferred accounts, which is about 59.5, those should have grown as well. And then you can adjust your spending, you can adjust your portfolio, you can adjust all of your funds and to suit your need, right? So that's another option. It doesn't have to just be in an overall index, doesn't have to just be dividend stocks. You could do a hybrid. You could even do just a straight dividend ETF, like SCHD is a good example. Devo is a good one as well because they're doing covered calls in the background for you. You don't have to do these income ETFs like JEPI, NUSI QLD, and XYLD as well. You could do SCHD, you could do VYM, you could do DGRO. Those are options as well, okay? So those stack up to just a traditional dividend portfolio. But you don't have to really manage it, right? You just invest $1 million in, say, DGRO or SCHD, and then it grows 8% roughly a CAGR, maybe a little bit higher than that. That will work as well, okay? Now, the dividend withdrawal rate, or the dividend, I'd say, showing an SCHD right now is what, 2.9%? I think VYM is roughly about the same. DGRO might be about the same, maybe a little bit lower as well. And so that could be an issue, right? So would you have to take money out of your principal? Would you have to take money out of your principal? Maybe, I don't know. It depends on how big your portfolio is. The $1 million example here, you'd have about $29,000 if you didn't touch your principal at all, if you invested it all in SCHD, and that might not be enough for people, right? So you'd have to touch your principal. Now, yes, that will grow every year. Probably outpacing inflation with the dividend CAGR. Now, my dividend portfolio that I have, so I have dividend stocks that are about $110,000 in individual stocks, and then I have these income ETFs up here, and this income ETF down here, and then I have Devo, which is kind of a mix between a dividend portfolio and an income ETF. Now, that's not going to grow as much as, say, a SPY dividend, or it's not going to grow as much as an SCHD or a DGRO dividend as well, or individual dividend stocks to outpace inflation per se. Devo has a pretty decent CAGR, but all these other ones up here really don't have a CAGR at all, so I'm not really going to outpace inflation 100%, right? Some of my stuff will, but some of it won't. That could be an issue for some people. I'm not really worried about that because I have other ways to combat inflation. I'm combating inflation with the options income, running options against Qs, SPY, IWM, and these other accounts, kind of churning those in a wheel strategy. So those are the three options I think that are probably the most common, most popular. And, at the end of the day, I think they're all gonna work for you. And at the end of the day, it's very tough to say this one's gonna be better than this one. My portfolio, I just feel comfortable having that income come in, right? I have about $6,000 coming in. Now I have other investments in there as well. $6,000 coming in, and it's not gonna, grow as much as a SPY or an overall market or a dividend portfolio. It's not gonna outpace inflation as much, but I'm still gonna combat it, right? Especially if I'm not using all that income. If I'm not using all that income, then to me it's a moot point, right? So at the end of the day, people say, oh, this is better than this, or this is better than this. Well, it's very hard to say over 30 years of what is gonna do better. Yeah, you can compare it against the historical numbers and all that, but at the end of the day, what is it? Past performance is not indicative of future results or something like that, whatever that common saying is. So I think at the end of the day, you're still gonna have a large, U-Haul following your hearse. Ideally, you wanna have a little teeny Toyota front end U-Haul following your hearse. You don't really want a large U-Haul following your hearse when you die. You worked all those years to, you spend that freaking money. Why not be the Costanzas and spend all your money in retirement and not leave anybody anything? You worked really hard for that money. Why leave a big old U-Haul, right? Unless you want a generational wealth, but in my opinion, unless you teach your kids how to deal with that wealth that you're gonna hand them down, they're probably just gonna be broke in a year or two. They're gonna spend it down, right? So hopefully if you're gonna leave generational wealth, that you teach them how to deal with money, and or even maybe set up some sort of trust fund where it gets spread out like an annuity or something like that. So, all right, well, those are the three options. Obviously, there's a lot more ways that you could skin this cat if you wanted to. So I don't know which way is the best way. At the end, I think in general, they're all gonna work. Everybody's gonna have a different risk tolerance and all that. Everybody's gonna have a different investment style. For me, I like to have that income to kind of just, okay, I got this amount of money coming in, I don't have to worry, and it's a mental thing for me. So let me know which method you're gonna go down and which way kind of suits you the best. I'd love to hear you comment down in the comment section on which method you're gonna do. So anyways, until next time, go ahead and like and subscribe if you're interested in future FIRE type of videos, and we'll see you in the next video. Thanks for watching.